All right. So let's look at the rate of return on a life insurance policy. So the funding calculator, which is one of my favorite calculators in here, because this is probably one of the most misunderstood tools out there in the financial world. It's been bad-mouthed by every other industry, and I think part of that's because every other industry has figured out who the enemy is, right? And they're all attacking the insurance industry. And so when we look at this, I'm going to put in an age. We've got some values in here built in for a 35-year-old that we pulled in before this meeting. So I'm going to go 35 out to 70. Now, understand in here, 35 to 70 is not 35 years, it's 36 years. Because it's age 35, finishing with age 70 is actually a total of 36 years. When I do this, I always like to go at least a year beyond whatever the level term is that I'm going to use in my calculations. And we're going to go in here and we're going to load stored life insurance data because I already have it stored in a particular spot. Just pull up one there and we'll pull up that 30-year term even though we're not going to use it right away. And just put it in this. Yep. And okay. All right. Now what we see down on the bottom is an internal rate of return of 3.94%. Most of you have the ability to print the rate of return column at the end of the illustration. I would really urge you not to do that, only because internal rate of return is a very difficult thing for people to understand. Sometimes we'll help client understand it in here. Pull up just real quick, the life insurance values tool. So this is where the data was stored. And when we look at this stream on number one there, what we see is that internal return starts at a negative 34%. 38%, and it grows down there until in that 36 year we hit the number that we were looking at here. What people think in their mind when they see that is, I have all these losses, finally I get to a point where I'm earning 3.8, is that what it was? 3 whatever it is per year. Is that the way internal rate of return works?
Yeah, 3.9.
No. What internal rate of return does is, whatever number it gets to, it means you earn the equivalent of that every single year. That's a hard thing for people to grasp. What do I mean by that? Well, let's go back to the funding calculator and put in, or copy that 3.94% down there with all the decimal places. And let's put that up here in the annual investment rate. So what this is going to do is it's going to say, okay, what if you didn't put the money in the life insurance policy and you put it in an alternate account? And you can earn 3.94% every year. Now, if you look down at the bottom, what's the cash value we have at the end of the time frame? $2,069,234, right? That's what it would grow to. Based on that same cash flows in another account, an alternate account, let's look at the alternate account. What do we end up with at the end if we earn 3.94% with change every single year? The same $2,060,234. So when we see an internal rate of return calculation, whatever number that reaches means you earn the equivalent of that every single year. But when a client sees that with those negative numbers and finally getting positive, they're thinking, I'm losing money, and I'm finally getting where I'm earning 3.94% per year. So the reason I caution you about using that is the client's not going to see it the way it really is in most situations. Does that make sense? All right. So let's go back to the life insurance inputs. We see our 3.94%. When we're talking about rates and battling rates, people a lot of times don't get real excited about that number because we've done a poor job of explaining what that is. We didn't go through the principles. We didn't go through the objectives or wish list with the client so that we can apply that across the board. This is a safe, liquid asset. It is a certain liquid asset, earning 3.94. That's the class that it belongs in. What in the world is earning anywhere near that today? Can anything touch that? So that is a tremendous rate of return. People ought to be happy about it. But when we compare that to invest, well, I heard you could do 25% in real estate. Yeah, but you're taking on a whole different risk scenario and everything else. For a safe liquid asset, this is a terrific rate of return. What is equivalent in safety and liquidity? CDs, money markets, checking accounts, can in the backyard, right? Are they doing 3.94%? And all except for the can in the backyard, are you having to pay tax on the measly earnings you're getting from those other assets annually? What if we were paying tax in a 28% bracket? Then what it would take in the alternate account to deliver that same $2,069,000, you'd have to earn 5.47% every year to pay the tax and end up with the same cash value. What if you wanted to protect your family in the unlikely event of a premature death? How would you cover that if you didn't put money into the whole life insurance? Term, right? You'd have to buy term. All right, so let's bring our term rates in here for $1 million a term. And if we scroll down, actually on this one, what a lot of other companies do is they push that premium way up. So what you would see is at age 65, that premium might be $50,000 or $60,000 for $1 million of coverage. And a lot of times people look at that and say, well, that's the insurance company trying to force somebody off the risk. For your knowledge, I wouldn't try to explain this to a client, but understand when an insurance company does that, that is the actuarial cost of getting that term insurance back on the proper mortality curve because they undercharged for it for the previous 30 years. That's not an overrated cost. That's the actuarial cost for getting it back where it should be for it going long. Okay, so when we look at this, what do we have now on our return? You can leave it all the way out on this one because it's not that high. They might actually keep it.
Okay.
5.71%. So you'd have to earn 5.71% in an alternate account every single year. And if you did that at the end of the time frame, you wouldn't be better than the whole life insurance. You would only have as much cash value and you would have lost the death benefit. And we could do that, but it's going to way overprice the cost on those last years because it's going to try to catch that up at those rates, so I wouldn't do it on here. But that's where are you going to earn 5.71%? Well, the market's done an average of whatever for how long, right? Okay, if you do that, are you going to take on some additional costs in the way of fees? Well, let's add fees to this one. If we had 1.5% in fees, which is not nearly all of the cost that occurs there, basically you'd have to earn 7.32% every single year to pay the fees and taxes, and ultimately you would only end up with the same cash value and no death benefit. How could people say life insurance has a terrible rate of return? It's that one-liner that people buy. You say it 7 times and it becomes fact. But it's not true, is it? This has a terrific rate of return when we understand what it is. Let's take off the fees, Kim. And let's look at something real quick. Annual investment rate. Let's go to 2%. Let's say that we can get 2% in CDs. And I know there's some of those out there, but you ought to see the teaser deals, what you have to do to qualify for that behind the scenes. So it's not really. But if we look at it this way and go to the cash-on-cash comparison, here's a comparison. The life insurance policy is going to be behind this 2% account for 8 years. Is that true? Yeah, but look how much it's behind. In this case, it's never behind even a premium. And from the 9th year on, it walks away from it, and we have the death benefit. And that's huge. That is huge.
Repeat, please.
And it has more liquidity. So here's the key piece here. Is the life insurance policy an and asset or an or asset? It's an and asset, meaning I can put money in here and I can put it in real estate or somewhere else. Are most other assets and assets or assets? Or, one of the things that Nelson Nash said was, when you are in a position of cash, opportunity will seek you out. If I'm in a position of cash, can I take advantage of what might come along, that once-in-a-lifetime thing, because I'm in a position of cash in my life insurance policy? So there's so many bigger pieces to the way the life insurance policy works, along with the certainty that it provides for the uncertain assets that I might want to invest in.